Now I want you to refer to your profit and loss statement. Remember that we are busy with our parent and our subsidiary. We consolidate, we add 100% of each. Guys, important, this is only an extract. This is not a complete set of our profit and loss statement. You need to ensure that you know this, and this is your RS1 rules. When I work through revision questions, I will include important information and principles on my revision sheets and my templates. Therefore, guys, I do recommend that you do the same. On your profit and loss statement, that we have a line item profit for the year and total comprehensive income. That total comprehensive income we divide into 1 our profit and 2 our OCI. Now each of these will then be divided into our owner's portion and our NCI portion. This profit for the NCI, the 4,500, should agree to your statement of changes in equity. Therefore, guys, in your statement of changes in equity, you will have a non-controlling interest column, and then the profit for the year shall be included, 4,500. And remember that this should agree to your analysis of owner's equity. Remember, we are only looking at the current year's portion. Therefore, guys, in this example or this extract, I've included a change. If we look at only the current year, you will have to include this portion where I circle, guys, as well as the profit after change, and the total of these two circles, this shall be the 4,500. And if there is an OCI account or line item included, this should agree to your profit and loss statement, your other comprehensive income, this light blue block. Now guys, this is your test that you need to ensure that this agrees. Now I want you to refer to your statement of changes in equity. Now, extremely important, your share capital shall always only be your parent. You need to know that. You will normally have a retained earnings, revaluation surplus. We've talked about the mark-to-market reserve, guys, and your NCI. Now, what I'm going to do when we look at the analysis of owner's equity, I'm going to indicate to you the important principles on how you can test and quickly calculate certain amounts, especially if your question indicates that you need to prepare the statement of changes in equity. Guys, this is not difficult. You just need to ensure that you understand your analysis of owner's equity. Okay, so let's refer to the analysis of owner's equity, as this is our extremely important section. Remember, we are only looking at the subsidiary. Our analysis of owner's equity will divide into 3 sections. You will remember 1, our at acquisition section, 2, our since acquisition section, and 3, our current year. Now, when we refer to our at acquisition section, you need to remember, guys, your IFRS 3 rules. Now, what is our IFRS 3 rules? The main principle of IFRS 3. When we have a parent that purchased shares in a subsidiary, the consideration paid by the parent to the previous shareholders should be at fair value. Okay? Then the assets and liabilities transferred into the group of our subsidiary we call your identifiable assets and liabilities, and this should be at fair value. Now guys, if they indicate to you that at acquisition date there is fair value adjustments relating to this assets and liabilities, you need to know that you will have to include them at acquisition. And you need to remember that there might be tax implications on this. Okay, so guys, you need to be able to identify this from the information provided. And if there is fair value adjustments on the considerations section, guys, in whose records will you include that? In the parent. So guys, I've included here in this blue block the journal entries that will be recognized in the parent's separate financials. In your parent's separate financials, when your parent purchase the shares, your parent will debit the investment in the subsidiary. This is an asset that increased. Remember guys, we are busy in the separate financials of the parent. Credit, bank, PPE, share capital, and so forth. Guys, you need to read how will the parent pay for the shares. Important, you need to read. And then remember, your acquisition related costs shall be expensed to your profit and loss. Now, if we expense this to our profit and loss, what will our journal entry be? We will debit the expense in our profit and loss, and we will credit bank or creditors. You will have to read. Except guys, if there is costs relating to issue of debentures, shares, etc., you will first capitalize that. Therefore, you need to remember there is an exception. Now, when we look at our at acquisition elimination journal, this will be this block, guys, the red section that I have included. Remember, first thing, you will have to take out your share capital. Therefore, debit retained earnings, debit your goodwill if there is goodwill, guys. Remember, if there is goodwill, you will recognize the goodwill separately. Now, what does it mean to recognize this separately? You will have a separate line item on your statement of financial position that indicates goodwill. Credit your NCI. This total of your NCI, guys, this total where you credit shall agree to the total included in your NCI column. This dark blue circle. Okay. You will identify that we will have to credit the investment in the subsidiary. Why? Guys, this is our group journal, our elimination journal. And if there is any fair value adjustments, you will have to include this in your journal. And remember your tax. Guys, I've included how to calculate the bargain purchase as well, and that this shall be recognized in your other comprehensive income. Now I want you to refer to the since acquisition section. Remember guys, if there is intra-group transactions, you need to identify the implication on each period. So guys, I'm going to write down intra-group transactions that you need to remember, that you know, and that you need to look at. Number 1. And number 2, guys, if there's fair value adjustments at acquisition, you need to determine what is the implication on the since and the current period as well. And this will influence the retained earnings and the current period's profit or losses. Now we are still busy with our NCI section, and I want to refer you to this amount, the orange XXX. Now guys, remember your NCI increase on the credit side. I have included a journal, this light blue journal, guys, where you credit your NCI as your NCI increase and you debit your retained earnings. Now this will be the orange block amount. Guys, I'm now teaching you the principles, the easy things that you need to know. Okay. Guys, remember, if you study the journals, you need to please ensure that you understand them. Ensure that you know the signs. Remember, if there's a decrease in your NCI, you will have to debit your NCI. Guys, I promise you, at the end of CTA years, I still get these questions. Therefore, ensure that you understand this. If our NCI increase, with let's say 50,000, your journal entry will be to debit your retained earnings with the 50,000. Why do we debit our retained earnings? We are busy with our group. Therefore, our group's retained earnings should decrease with the amount that should be allocated to your NCI. Okay? Because in our group, we only want the retained earnings that relates to our group. We do not want our NCI's retained earnings in our group's retained earnings. If we need to declare dividends, remember those dividends and retained earnings only relate to the actual parents. Okay, so therefore guys, then our NCI will increase with the 50,000. Know your signs, please guys. And remember, there can be mark-to-market reserves as well. There can be revaluation surplus, etc. You will have to read and identify the information provided. Now let's move on to our current year. Okay. Again, guys, know your signs. If our total profit is 4,500, and this is profit, therefore it's an increase. If it's an increase, guys, you will have to credit your NCI with a 4,500 and debit your NCI in your profit and loss. Now let's quickly talk about that debit again. When we refer to our group profit and loss, do you agree with me? Our expenses increase on the debit side. Therefore, in our group profit and loss, we need to take out the portion that relates to our NCI. If we need to take this out, this will be an expense, and expenses increase on the debit side. Guys, for now, please ignore the disposal section. Please ignore this light gray area. I will get back to this. For now, ignore this. Okay. Now, when you refer to the dividends line, remember guys, always, if you include your template, include a line dividends. Most probably, 90% there will be dividends. Extremely important that you identify the date, especially when there's change in ownership. Is the dividends declared before the change or after the change? And I have included your journal entry. This is your elimination journal entry. But guys, again, you need to ensure that you understand this. So let's just quickly talk about it. We have a parent that owns shares in a subsidiary. Now, in the separate records of our subsidiary declares dividends. Therefore, debit, dividends declared, and credit bank. Let's say this is 10,000 and our parent owns 80% controlling interest in the subsidiary. In our parent's records, the parent will debit bank and credit other income with 8,000. Okay. Now guys, do you agree with me that the bank accounts will net off? And we now need to eliminate the dividends section. Therefore, if we need to eliminate this, we need to take it out. We need to reverse the original transaction. And we will then debit our other income with the 8,000. We will credit our dividends declared and paid and debit our NCI with the 2,000. Now guys, you see this is exactly the same journal as per the journal I've included. Remember guys, I will still get back to the disposal acquisition section in the analysis of owner's equity. I want you to please refer to the disclosure section in your notes, this page. On your left hand side, you will identify that this relates to our subsidiary. IFRS 12 indicates to us that when there is a subsidiary, we need to disclose the composition of the group, the NCI interest, and if the dates differ between our subsidiary and the parent, the details relating to this. Now, in a question in the exam, they will indicate to you if the NCI is material to the group. If this is the case, you need to include the name of the subsidiary, the principal place of business, the proportion of ownership of our NCI. If the voting rights differ, profit and loss allocated, accumulated NCI at the end of the reporting period, and then summarized financial information about our subsidiary. Guys, there is additional requirement if there is significant risks. I normally indicate that you should rather disclose more information than less. And then if there is disposals, acquisition, guys, you need to indicate the details thereof. Now guys, I want you to refer to the change in ownership. I am not going to work through this with you again. You have already done this in Learning Unit 6 of FAC 3704. I've worked through this in detail, the steps. What I want to do is I want to discuss the analysis of owner's equity section. Guys, remember this section that I have included. So my purpose of my analysis of owner's equity is that I wanted to try and include all of the important information again on one page for you to be able to see, number one, the bigger picture, and number two, to assist you if you need to study everything. Okay, guys, extremely important, your foundations going forward for groups should be very, very solid. Okay, this is purely on a third year level. First, guys, you will remember that we have acquisitions and disposals where the subsidiary remains a subsidiary, guys. Remember, your subsidiary remains a subsidiary. Therefore, there is no change in status, no change in ownership. Okay? Now, guys, if we look at only the acquisition section, I have included a formula. But guys, remember, you need to ensure that you understand this. Now, this will be the net assets, and I have indicated here this green section. This is your net assets, guys. In your net assets, I want you to identify goodwill line item is added. Therefore, your net assets, if there is bargain purchase, you will add. If it's not a bargain purchase and it's goodwill, you need to deduct the goodwill. Divide this by your total shares owned by the parent times this by the shares acquired. Therefore, this will be your first calculation. The second thing will be to obtain the consideration. And the difference between number 1 and number 2 in this scenario, the 10,000 and the 15,000, is 5,000 change in ownership. Now, guys, let's think about this. Our parent purchased additional shares from our NCI. Therefore, you will identify that we take out this 10,000, guys. Are you with me? The 10,000 in our NCI, we take out and we include this in our parent. Then we calculate our change in ownership. Our journal entry will be to debit our NCI as our NCI decrease. To debit the change in ownership. Guys, you see, if it is in brackets, here, this 5,000 is in brackets, we debit our change in ownership and credit the investment in our sub. Now, why do we credit the investment? Guys, very similar to our elimination journal. Guys, please ensure that you are with me on this. I know it can be very confusing with all of the colors and everything. That's why I'm trying to include blocks and show you this is where I am currently. Now guys, I want you to think about this journal where we debit our NCI, debit change in ownership, and credit the investment. And I want you to refer to your statement of changes in equity. In your statement of changes in equity, you need to include a column change in ownership, and you will identify that we have a line item acquisition of interest. And guys, brackets. Why brackets? Our journal entry was to debit our NCI, to debit our change in ownership, and to credit our investment. Remember, if we debit an equity account, this is a decrease. What I want you to identify is that there should be a line item included in your statement of changes in equity where we include the decrease of the 10,000 of our NCI. Guys, when I refer you to the analysis of owner's equity, you will remember our NCI decrease with a 10,000. Therefore, we need to include a line item where our NCI decrease with this 10,000. Now, please refer back to your analysis of owner's equity. Now, I want you to refer to the disposal section only. Remember, first thing, we need to calculate the transfer from our parent to our subsidiary. This will be your net assets. Guys, if you refer to the formula, net assets plus bargain, or if goodwill, you need to minus, divided by the total shares owned by the parent times our shares disposed. And this will result in a debit in our investment in the subsidiary, credit our change in ownership, and credit our NCI. Now refer to your statement of changes in equity. Guys, there's a line item, disposal of interest, and important guys, remember, if we purchase additional shares purchased by our NCI, we need to include this in our NCI in a line item as there is an increase. And then guys, remember a positive 2,000. Why? In our journal, we've credited the equity account. Guys, I've included your calculation on change in ownership in the subsidiary. If you want to work through this again,